Hello, everyone. My name is Andrew Wall, managing partner here at CPA for IT, and I'm excited for today's session on mid-year tax planning and mid-year review. Let me, without further ado, share my screen here. Awesome. Okay, hopefully everything is coming through for everyone. As I mentioned, my name is Andrew Wall. I'm the managing partner here at CPA for IT, and this session is on mid-year tax planning and practical advisory review for incorporated professionals and owner managers. We're going to start with a little bit of housekeeping. If you are joining us live on Zoom, feel free to post your questions in the Q&A. I'll do my best to answer those questions as we go throughout the session. At the end of the session, I'll do my best to have a look at the chat just to make sure I haven't missed anything. And of course, if you're following along on any of our various social media channels, you can please like, share, comment down below. And any of the comments or questions that come through on all the social media channels will be relayed over to us live here by one of my colleagues, and we'll do our best to answer those questions. If for whatever reason we don't get a chance to answer those during the live session, we will, of course, come back and answer those questions as we go through our social media content. So again, thank you guys for joining us today. And hopefully this session will help you make decisions for your business while there's still time. Again, this isn't a magic pill. It's just math before sort of the end of the year, so we can do a bit of planning. Let's talk a little bit about why mid-year reviews matter. And that's because, unfortunately, accounting is all too often reactive, where we're just processing transactions that have happened in the past. And when we're reactive, it's very difficult for us to be as tax efficient as we possibly could. And what we want to do is use these downtimes in these summer months to plan for the year. And though I know that each one of you has a different year end, and in putting together this session, it's a little bit difficult to figure out when exactly your mid-year review should be, because it's going to be dependent on your corporation. So a lot of these dates you're seeing are around a typical December 31st year end. But you can correlate these sort of timelines to your own corporate year end. So in the first quarter, you want to be sort of looking at the history. In the second quarter, you want to start developing patterns and seeing what's going on. In the third quarter, you want to be doing your planning. And in, at the end of your year is when you start taking actions before the close of the fiscal year end. And then in the first quarter of the following year, you're going to repeat this process. And these planning conversations, if they happen throughout the year, it gives you more time to make sure that you are structured properly. And this could be for about any decision that you're going to have is, hey, should I incorporate a holding company? Hey, should I invest in an IPP? Should I get insurance products? Should I go salary versus dividend? How can my tax planning be more effective with my family members? What expenses am I maybe missing out on? There's a whole slew of questions that you can go through. And again, those are going to be dependent on your individual business. So we service a number of service-based clients, including IT consultants, doctors, real estate agents, and owner managers. From the IT consultants, obviously taking a look and evaluating your PSB risk, which is an issue that unfortunately never seems to go away. It just seems to go through these peaks and valleys of how interested the government is in cracking down on what they perceive as personal service businesses. Again, I would remind everyone that we've got some new tools that we've launched recently, including a webinar, an online course designed to educate independent contractors on the difference between employment versus independent contracting, so that you can understand the risks that you're taking if you're choosing to go the route of independent contracting. And we've got a classification tool that's using AI to analyze your individual situation to determine whether you truly are an independent contractor or you're at risk of being classified as a personal service business. And of course, we want to look at compensation, directors' advances. And I'd say directors' advances are going to be an issue across the board for most of our clients, because many of our clients are following the strategy of taking out money from their corporation in the form of a shareholder loan and declaring a salary at the end of the year based on how much money they've taken out throughout the corporation. But that mid-year review is a good point to check to see what are your draws looking like? How much money are you taking out of your corporation? And, if this continues throughout the course of the rest of the year, what are the tax implications of maintaining that continuous withdrawal amount? Or should you curtail that or look at other strategies for accessing cash flow so that you don't have to pull it out of your business? With doctors, we might be looking at strategies to reduce high income. Maybe you're exceeding the small business deduction threshold. Maybe you've got investments and we're worried about tax loss selling. Maybe you're looking at whether it's a good time to buy equipment. And then family payroll, again, synonymous for all of our clients. Should I be doing income splitting with my spouse? What kind of income is she going to have this year? Should I be doing income splitting with my children, my parents? Is there anyone else in the family plan that we can use as a tool for income splitting? Because as we've discussed in many of our past sessions, the more people we can split the income between, the less overall tax that you're going to have. And that's because of our marginal tax system, where if I have two people at $50,000, that's less tax than one person at $100,000. And of course, real estate agents, they're going to have more variability than just about any of our other clients. So this is, again, looking at making sure that we've maximized and done the appropriate deductions. We look at maybe capital asset purchases as a tool that we might use to minimize income in those peak value years. We can look at tax deferral strategies for those low income years. And then, of course, for all owner managers, we want to look at that corporate cash, personal withdrawals, and tax installments that have been made and what we think is going to be coming out based on what we're seeing so far. So a lot of benefits can come out of this sort of mid-year review. And we break this into a sort of a 5-step process. So first, we want to look at compensation. So are we doing salary? Are we doing dividends? How much CPP do we have? How much RSP room do we have? And figuring out what's the best structure for that. Then we want to look at the corporation's balance sheet and look at the cash flow position and understand, hey, do we have a bunch of money sitting in cash? Should this be redeployed and reinvested somehow, some way? Do we want to look at pulling those funds out? Do we have credit balances or debit balances in the director's advances? And where's the liquidity of the corporation? And do we have enough set aside for our taxes? And again, there's a very, very, very back of the napkin rule, but we tell everyone you should set aside about 30 cents of every dollar you earn for corporate taxes, GST, HST, and payroll taxes. Typically, the average person will have a little bit of money left over. I just did one with a client, and he came to 28%. So if you save 30%, you're probably good. Next, we want to look at your wealth accounts. And sometimes we'll refer to this as your personal net worth. And we want to look not just within the corporation, but we want to look at RSPs, at TFSAs, at unregistered investments, at personal assets like the home. And we want to look at that to get a picture for where you are now, because our pyramid of power that we like to do for every one of our clients is look at where you are now, where you want to go, and set a trajectory for how you're going to get there as far as, how much money should you be putting aside each year. We call that our pyramid of power, but that starts at looking at your overall wealth, not just what's inside the corporation. Next, we'll propose some risk cleanup. So whether those are shareholder loans, payroll liabilities, HST liabilities, PSB, expenses that are above average, expenses that are below average, any of the risk that we see there, we want to do our best to clean it up and minimize it wherever we can. Of course, we don't want to let the tax tail wag the dog, and we'll take educated risk where appropriate, and have no problem with us doing anything as long as it doesn't, cross any black lines. If it's in the gray area, if there's risk there, but it's educated risk and informed risk, that's okay. But if you're taking risks that you don't know and you don't understand, that's where we tend to have problems. And then finally, now we take action, right? So based on this risk cleanup and this assessment, we want to put together some action plans. Are we buying an IPP? Are we investing more money into our RSPs? Are we putting money into a TFSA? Do we want to do RESPs for the kids? And now we start to take those actions. And with those actions, probably one of the most important mid-year questions is how much money should you take out of your corporation and how should you receive those funds? So salary, the great thing about salary is it's going to build up RSP contribution room. And I would argue it's also a positive is that you're also going to be contributing into CPP. Now, some people might consider CPP to be actually a negative because it is a cash outflow. It's money going out today that you'll receive in retirement. And it's not necessarily the greatest investment that you'll ever make, but it is a guaranteed form of income in retirement. And we do like that, or at least I do like that because I've seen way too many 2008s and 2028s, unfortunately, is what I'm afraid of. So we want to make sure that we have something set aside so that, unfortunately, most of you could never live off of what you make in CPP and OAS in Canada, but you could in South America or, Southeast Asia. So I like CPP from that aspect of sort of a guaranteed subsistence in retirement. The downside is it does take payroll discipline. You've got to make sure your payroll remittances are in on time. And payroll can be a little bit complicated. We've got regular remitters, threshold 1, threshold 2, and you might be monthly, you might be quarterly, you might be annually. And if you're confused by all that, what I would say is go and check out our entire session dedicated to payroll remittances that we do usually around November, December timeframe. And that walks through what those different thresholds are and what triggers them. But the reason that this is so important is because if you miss those deadlines, the penalties on payroll is quite significant. It's 10% if you're a minute late. And if you're late 2 years in a row, it could be up as high as 20%. And that's because CRA is looking at this as your corporation and your employer are separate entities. In your situation, they might be the same, but CRA sees them as separate entities. And if you take money off your employee's paycheck that you're supposed to give to the government and you don't give it to the government, the CRA believes that you've stolen that money from the client. That's their perspective. And, certainly if you weren't, if you were a non-arm's length employee, or if you were an arm's length employee, that would be the situation. But for most of you, it's yourself, but it's still a very real issue. Now, dividends take away that issue with having to worry about payroll deadlines and payroll remittances and figuring out when you have to pay, because you just pay when you file your personal taxes. It's part of your personal taxes. There is no payroll remittances, there's no CPP, there's no EI. And the biggest advantage with a dividend for some people is that you're not paying into CPP. And that means that cash outflow isn't going into CPP. So today, less money is leaving your bank account. Unfortunately, that means that you're not putting something aside for your retirement. So if you are going to go the route of dividends, you probably should be setting aside about 5 to 10% of your dividend amount in some sort of forced retirement savings, whether that be inside your corporation, an RSP, a TFSA, et cetera, et cetera. Now, generally speaking, you will have heard me say over and over again, I don't recommend mixing dividend and salary. It's not that you can't do it. I just sort of feel like if you go that route, you're not getting the full benefit of either, right? So now you've contributed some CPP, but you've probably not maximized the CPP. And you're getting some RSP room, but not the full RSP room. So I figure, in my opinion, you pick a strategy and you stick with it. And that should be based off of whether you value RSP, whether you value CPP, and the profitability of your corporation. And the reason I say the profitability of your corporation is because the other big difference in a salary and dividend is how they are taxed. So a salary is an expense to the corporation. So if you pay someone a salary of $100,000, the corporation gets a deduction of $100,000. Now, because you pay the employee $100,000, you would take $30,000 of that off before you give it to them. So you give them 70. and you would take the other 30 and give it to the CRA for their personal income taxes. But you get that full $100,000 deduction. Now, a dividend is different. Dividends come out of retained earnings. So you have revenue minus expenses becomes net income before taxes. You pay your taxes, and your net income minus your taxes is going to be your profit or loss for the year that then rolls into your retained earnings. So if you had a profit of 100,000 this year and last year you had a profit of 50,000, your retained earnings at the close of the second year would be $150,000. So the dividends are not a deduction to the corporation, which means effectively you've already paid corporate taxes on any dividends that you're paying out of your corporation. Because of that, when you receive a dividend as a shareholder, you get a dividend tax credit, which means you personally are paying less tax. Now, some people believe that means there's less tax on dividends, but it's not. It's just an equalization. There's something called the theory of integration, which the CRA follows, which is a strategy to make it so that there is no tax advantage of choosing a salary over a dividend. But how they are taxed is different, and that can make a difference in the total taxes that you pay, because if your corporation has no income and you deduct an expense, you create a loss. And if it's your first year of operation, you can't do anything with that loss. So you've got this loss, but you've paid the full personal tax rate, right? Now, if you had taken dividends, you are going to get a dividend tax credit for that. And your corporation may not pay taxes because maybe it doesn't have a profit in the corporation, or maybe it pays a little bit of taxes, but not, on the full 100,000 or whatever the dividend is. Now, it gets a little bit complicated, but generally speaking, because of the way it's structured, what we typically recommend is during income earning years, you take salary, which is building up RSP room, building up CPP contribution, and you are paying the full personal tax. Once you hit retirement and the corporation is no longer earning income, but hopefully is now an investment vehicle that is generating returns from investments, you switch to a dividend strategy where you start pull the money out of the corporation as a dividend, and you're into a nice low tax bracket personally, or low tax rate. It's still the same tax bracket, but you're just getting a dividend tax credit that reduces it. Now, I do see we've got some questions coming through, so let me see if I can go through to those Q&As. On the salary versus dividend decision, would paying out all earnings as salary eliminate the concern about losing the small business deduction in a year where passive income significantly exceeds $500,000, e.g. 140K? Okay, I'm not sure I'm following that, e.g. 140K, but yes, it would, but it may not be the best decision to do. So let's say that you had I see what you're saying. So let's say you had $140,000 of passive income. That means 90,000 times 5 is going to be the amount of small business deduction that is withdrawn, which is basically only leaves you with room for about $50,000 of small business deduction that you can claim. So if you took it all out as salary, does that solve that problem? Well, yes, because now you've got less than $50,000 of net income to the corporation. So let's say that you've taken enough salary to bring it down below that $50,000 of room that you had remaining. So that's fine. You have all of your corporate income is being taxed at the small business rate, but you have to look at what impact that has had on your personal tax rate. If you're over, $250,000 and into the highest marginal tax bracket, not a very effective tax plan and tax strategy. What I would say is a better tax plan and tax strategy, if you're worried about exceeding the $50,000 passive income, is look at a holding company opco structure, right? Because with a holding company opco structure, we have a little bit more control over what expenses we can apply to the passive income. And so we can erode the passive income to bring it below that $50,000 threshold, or at least below the amount that it would be affecting your individual clawback, right? So let's say that you have $250,000 of profit, you could still have $100,000 of passive income, because, 100 minus 50 is 50,000. 50,000 times 5 is $250,000. Small business deduction limit is 500,000. Minus 250 still leaves you with 250, which would be enough for the amount of income that you have. And I know I'm throwing a lot of numbers at people and I'm going relatively quick. What I would say is that I'm just trying to give you guys an idea of the value of a mid-year review. And this mid-year review can be done on your own and do your own analysis. You can use an AI coach to work with you, like ChatGPT. Just don't give it any PID or personal identifiable data. Or you can book this with one of your account managers, who would be happy to go through this in more detail and explain some of these more complicated facts to you. So if I'm throwing too many figures at you, please don't get scared. Just let me know and I'll do my best to slow it down. So the other big thing that I'd say is critical of your mid-year review is taking a look at the cash flows we talked about. And the most important thing that you can do to minimize tax when you're self-employed is leave as much money inside the corporation. Because as many of you know, the corporation is a separate vehicle that pays a lower tax rate than you do individually. And substantially favorable, right? Like 12.2% versus the highest tax rate of 53.54%. That's a 40% savings in tax rate. And that's a huge advantage that allows you to potentially invest 40% more assets and to grow those assets 40% faster, potentially by leveraging a corporation. But the key to that is leaving the cash inside the corporation. And so what we always recommend to most of our clients is the strategy where you don't do a regular monthly payroll. You take your money out in the form of a shareholder loan. We look at how much money you've taken out at the end of the year, and we declare a salary on the minimum amount that we can. And that's because with this marginal tax system, we know that basically after about $35,000, $40,000, it's going to cost you more to take it out of your corporation than it is to leave it in your corporation. Now, of course, you may want to go above that because we want to look at this like once the year is gone, if you haven't taken money out of your corporation and used up and eaten up at least the lowest tax bracket and at least at the bare minimum, the basic exemption, that year is gone and you can't get it back, right? So there's a certain amount of money that makes sense. You should take at least something, and I'd say in the $35,000 to $45,000 range. The only exception to that would be is if you've got money outside of the corporation, right? If you're earning income from anywhere else out of the corporation and you're already using up your basic exemption, you're already using up your low bracket, then it doesn't make sense. But after you've taken that minimum amount of salary, the goal is to leave as much money inside the corporation as possible and use the corporation's deductible business expenses as much as we possibly can so that we can take as many of our cost of living, like our home office, our telephone, our internet, meals and entertainment. We can take as many of those costs and we can deduct them as business expenses in the corporation. We don't have to take them into salary. We don't have to take that money out of the corporation. These are just expenses for the corporation. But anything above those business expenses and the bare minimum of money that you need for the non-deductible expenses we can't claim, you want to leave in that corporation as much as possible. Now, what we want to do is we don't want to necessarily leave that in cash, and the corporation can certainly have investment vehicles. It can invest in physical property, it can invest in stocks, it can invest in other companies, it can invest in bonds. In fact, what it can invest in is great. It has a much greater extent of what types of tools you can use than, say, a registered plan like an RSP or a TFSA. So what we want to do is we want to make sure that we're looking at the cash flow of the business. We're understanding how much money are we taking out on a monthly basis. Is there anything I could do to curtail that? Could I make more of the money more of the things I'm pulling the money out for deductible by making a few small tweaks or changes so that those don't become salary or withdrawals, those become corporate expenses. Could I look at changing my lifestyle? maybe I don't need to go out for Starbucks 5 days a week. Maybe I can buy an espresso machine, and that could be an investment. But understanding that draining the corporate bank account is going to have very significant tax impacts on you. So this is something that we want to take a snapshot at. We want to understand, okay, how have we been doing for the first 6 months? How are we projecting that to change over the next 6 months? Do I want to try and reduce it? Have I been really good? And maybe I can even afford to take out a little bit more. Those are the types of mid-year planning we want to start looking at this time of year. We also want to say, as I said, look at the different registered accounts versus corporate investing. Again, I'm not going to go into the weeds on this because we have an entire webinar dedicated to this, and I encourage you to go back and check those past webinars where we talk about the difference between TFSAs, RSPs, first-time home savings account, corporate investments, and we talk about what are the right vehicles to do. But again, this mid-year, now we want to look at how much room do I have in my TFSA? When's the last time I contributed? How much room do I have in my RSP? Do I want to build more room in my RSP? Do I want to consider an IPP because I'm maxing out my RSP every single year? Do I want to move more money out of cash and into my corporate investments? Do I have enough set aside for my taxes and then some, so I should move it ahead? Of course, income splitting is a really key factor in reducing tax. So when we're doing the mid-year review and we're talking about income splitting, we want to look at what family members we have that we could income split with. Minimum age, and I say minimum, is 12. Preferably over 14, really preferably over 16. But we can employ children as young as 12 years old in some office type of work. So when we include family members for income splitting, we want them doing real work. Could be admin, could be bookkeeping, could be marketing, could be social media. It needs to be a reasonable pay. What I can say, especially on like social media side, where your kids probably know more than you do on this front, what would be considered a reasonable pay for a social media consultant is much higher than you probably think it is. But it does need to be reasonable and comparable to market. We also have to have clean records. So what we say is a job description is the bare minimum. Cash flow, if you're paying your spouse, it can go to a joint account. But if you're paying your children, you're paying your parents, we need to see the flow of money actually leaving your corporate account and going to their account. If they choose to gift that back to you or do something with that money, that's fine. But we need to see the money flow out to the family members, as for anyone that's not an actual spouse. We also need to, I would say, have a job description and work instructions. The payroll is again discretionary. A lot of our clients will do that as a one-time bonus, but you could go on monthly payroll if you're that type of individual who likes to be sort of organized and planned for the year. So there's still those options. Now, the biggest thing that we have to be careful of when we're looking at income splitting with family members is we will always structure our corporations with multiple shareholders, including your spouse and your children as shareholders. However, right now, there are some rules called TOSI, or tax on split income, that make it tax inefficient income split with children in the 18 to 24 range unless they're working full-time in the business. If you, the primary shareholder, the common shareholder, are over 65, then you can do income splitting with your wife and there's an exemption for that from TOSI through the use of dividends. But outside of that, in order to do dividends without being inadvertently hit with these TOSI additional tax penalties, or well, they're not penalties, they're just additional tax that make it tax inefficient, it's very, very difficult. Now, you can still income split using salaries. Those are no problems. But again, they need to have real work, reasonable pay, and clean records. And I think, again, the overall message here is, remember that The more people that we can income split with, the lower your overall tax. That means more basic exemptions. So if you've got 4 people, you got 4 basic exemptions, more low tax brackets. And yes, you will have more CPP to pay into. But again, that's something you're contributing to potentially for your children. Next, we want to take a look at